Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Really excited for today's show. We've got, a great guest, been on the podcast a couple of times. So warm welcome to Gino Barbaro. So Gino, welcome.
Brian, thanks for having me on, brother. How you doing?
Doing really, really well and excited to talk with you again. And for everybody listening, we got a lot of really, really good stuff coming up. So that said, Gino, do us a little bit of a favor and give us a very high level background into who is Gino Barbaro.
Well, I'll start from the beginning and I'll make it 30 seconds real quick. I
Cool.
used to be the restaurant guy. So I
hmm
partnered up with Jake Stenziano. So
hmm
he is the drug rep and I'm the pizza guy. That was our moniker. He was
hmm
working as a pharmaceutical sales rep when he met me back in 2009.
hmm
We partnered up. We started buying assets in Knoxville in 2013. We took us 18 months to find the first deal. So in
Yeah.
2011, we partnered. Our first deal was a 25 unit deal. 3 months later, we bought a 36 unit deal. Then we bought 136 units. And, to date, we've transacted on over 2,500 units. We
hmm
currently own 1,900 units in east part of Tennessee, Knoxville, MSA. We've got some in Morristown, some in Jeff
Yeah.
City. And it's been, for us, an incredible ride. Brian, Jake and I would always joke and we say, if we got 100 units, bro, we are rich. We're stopping. And then you realize
Yeah.
when you hit the 100 units, okay, there's a repeatable process. We
Yeah.
started figuring some things out.
Yeah, absolutely. And I mean, obviously, you guys have figured things out. And for people listening, if you ever heard of Jake and Gino, this is the Gino and Jake and Gino.
Ah.
If you didn't catch that already, so you started out, you bought a couple hundred units, and you just figure out we want to repeat it. Okay, how did that go from there? I mean, what challenges did you guys come into through the repeatable phase, and how did you grow your portfolio?
Well, the interesting thing is that I had a restaurant and I only had one for a little over 20 years. I
Yeah.
was stuck in that mindset of I'm gonna do this, I'm
hmm
gonna do that. Old school Italian dad, you got to do it my way. And I was really mired in that
hmm
thinking. But when I met
Yeah.
Jake, it's like, it's a different business. I
hmm
can think differently. I can do things differently. I don't know how to scale, but I'm sure
hmm
we can learn. So when we bought our first deal, it was all that first deal. It was all the focus was on that. Then we bought
Yeah.
our second deal. We had resident managers on each property. Jake was boots on the ground. I was doing the accounting. We were
hmm
splitting things up, doing really well. When we bought that third deal, I think everything changed for us because we
Yeah.
realized unconsciously you can't keep doing the same thing you were doing when you bought your first deal. You
Yeah.
can't bootstrap. What got you to the first deal is not going to get you to the fourth or the fifth deal. And we had to be completely honest with ourselves. I don't know about
hmm
you. I didn't come out of the womb knowing how to scale multifamily. So I went
Yeah.
out, I pulled out the pocketbook and I started throwing money down and we started paying for scaling up. We started paying for
Mhm.
traction.
Yeah.
And you have to do that because multifamily in real estate is
Yeah.
a business. And if you
Yes.
don't understand that it's a business and you think you're just accumulating assets, that's where most investors make mistakes. That's where I made my mistake back in the last
Mhm.
market cycle. And I did not want to repeat that mistake in this market cycle.
Yeah. I'll throw a couple cents in there. I got into a coaching program in 2018 before I heard about Jake and Gino, unfortunately, but we bought 8 properties in the next 16 months. Okay. That's
Wow.
fast and that's a lot. And we got to the
Yes.
point to where you were kind of saying, I think we grew faster than we could manage. And then we
Hmm.
stalled on our acquisitions because we realized, oh my gosh, guys, we have 8 properties, and then we had to figure out the management thing. And
Hmm.
luckily for us, that kept us from buying properties in 2021 and 2022. So
Hmm.
we just pure dumb luck. But yeah, the scaling part is not easy. And a lot of people kind of hit that glass ceiling.
What you did though during that part of the cycle is you probably bought right. Remember, we were going to talk about our three
Yeah.
step framework: buy
Yeah.
right, operate, and exit. So you bought at a basis that was probably okay. You
Yeah.
bought at the right part of the market cycle because rents are about to start accelerating.
hmm
When you knew that, I guess
Yeah.
with dumb luck and the fact that you don't want to outgrow your infrastructure, that's where most of us make mistakes. Unfortunately, in
Yeah.
our business, when there's deals to be made, sometimes you can't think about that because you've got some incredible
Yeah.
deals that may not come back in 10 years.
And
So
you're chasing acquisition fees at point. Well, some people are, but you're chasing
yes.
acquisition fees, you're chasing unit count, you're chasing those vanity metrics a lot of
Hmm.
times. But
Hmm.
yeah, anyway, buy right. Yeah. So let's talk about your philosophy, the buy right, the operate, the exit, and kind of how that has helped you guys.
Let me zoom out for a second for everybody
Yeah.
because I think this is important. When we go back to that pre 2008, I had
hmm
not invested with Jake yet. So I always call it life before Jake. I
hmm
didn't have a map. I didn't have a process. I was the investor out there that's going, I needed a deal. I
Yeah.
didn't even know what a deal was. I didn't know what I was going to do with the deal. And I didn't
Hmm.
know how to make money with the deal. I was all over the place. And I
Yeah.
made so many mistakes before I met Jake. Then I remember in 2013, when we put that first deal down, things started clicking. We're buying from mom and pops. We're buying in a specific market.
Hmm.
We're buying at a specific cap rate. We're getting a specific debt. We're going to buy this deal and operate it this way. And then here's the exit. So the whole business plan or framework started crystallizing after that first deal. And it's just a repeatable process. When you take this framework, you can go out and buy a self storage with it. You can go out and buy a
Hmm.
business with it. And that's alleviated a lot of the mistakes. It was a great run up until 2021. And like you
Hmm.
said, in 21 and 22, the framework was just not allowing us to buy any deals. And we're
Yeah.
just like, we're not going to buy this deal. We know that the finance right doesn't look right here. We know that we can't exit this deal profitably. It doesn't make sense. So for
Hmm.
anybody out there, it's buying, it's operating, and it's exiting. When you
Yeah.
put all three of those together and you build parameters, obviously the parameters for self storage to buy an asset are going to be different than multifamily, but you need to go out there and create it. And the reason why I love this framework is I was at an event about 3 years ago. It was a syndicator event. I forget the
Hmm.
gentleman's name. I'm good friends with him too. I'm
Hmm.
on stage with Jake and I look out to the crowd and I say, hey, how many of you out there have a buy right criteria? And nobody raised their hands as if they
Hmm.
had no idea what I was talking about. And I'm like, you guys don't have immediate income metric. You don't have a place in the market you want to buy. You don't have a unit count. You don't have like two beds, one bath, townhomes. You don't have amenities. You don't have age of the asset. And they were looking at us like deer in the headlights. They were doing what I was doing in that last part of the market cycle. And if
Yeah.
you're not crystal clear on what you're buying, you're going to be in big trouble. And the problem with that is it does change throughout the market cycles. And if you
Hmm.
don't understand or adapt to that, this buy right criteria that I have today is not the same thing that when Jake and I started. It's far from it because the market cycle has changed. So when you look at a framework, whatever one, pick one that works with you, but you need to be able to buy these assets and understand why you're buying them, to be able to tell your investors, to be able to tell the brokers why you're doing it, be able to have to know the operation, which you're talking about, the KPIs and the metrics to run this thing. And then ultimately, how are you going to crystallize that equity? Are you going to refi the deal?
Yeah.
Are you going to sell the deal? Or are you going to hold this deal long term and you're okay with that? Understanding those three, putting those three together will, as Trump likes to say, limit the downside risk and the upside will take care of itself.
Yeah. Yeah, yeah. That's something that I think the more that I do this, the more that my focus is on that downside and not the upside,
Yes.
with the financing, it's just bridge loans, they always have a chance to bite you, it doesn't matter where you are. If you can mitigate a lot of that downside. The problem is this is I guess it depends on how sophisticated your investors are. If you have really sophisticated investors, they see mitigated downside and they're happy, right? The less
Mhm.
sophisticated investors, they're only looking at the upside. This is something that I've been talking with my partner about quite a bit is how do we educate that kind of middle of the road investor to make them see that you want to mitigate the downside first? Because we've had people interested in our deals that have gone other places because their slide deck has a higher number. Anyway, love the approach, but
Is that a bad thing, though? Ask yourself, is that a bad thing? Because that may be one of your
Mhm.
core values unconsciously, is
Yeah,
where you want to limit downside risk. And your marketing, your messaging should be to that. And if you want more sophisticated investors, and that's what they're going to want to hear, I don't look at that IRR number. I don't really care about that number because we
mhm,
don't syndicate. Even if you are focused on that number, well,
mhm,
how are you getting to that number? And
yeah,
explain to me what's going on. So for any investor out there, they need to understand that it's really like building a foundation. And if you don't explain that to your investors, because all they're looking is at rosy pictures. Now, the great thing about it is now you've seen what's happened in the last 3 years. Now
yeah,
people will come back and go, "Oh, money's not free. People have lost a
mhm,
lot of money in real estate. Real estate's
yeah,
risky. Now we're here to really limit that downside risk. We're willing to take a little less on the upside, but we're willing to protect your capital and get your
yeah,
capital back to you." If you have that conversation, that resonates more with, I think, the average investor as
yeah.
well.
That's a strong, strong story on that one. So, but awesome, awesome, awesome. So you talk about the buy, the execute in general. What does your portfolio look like right now? And like, how did you set it up so that, you're not in a position that a lot of other operators are in where, let's face it, a lot of operators are sitting with a lot of distress and, a lot of them have a couple losses under their belt now.
Well, before we hit the record button, we had
Yeah.
I would say a
Yeah.
beautiful conversation. I was like pouring my heart out to you.
I wish
You're
we had
pouring your heart
recorded
out to
that.
me.
Yeah.
And it was interesting. I'm like, Brian, I look good now because I didn't look good back in '08. I made all of those mistakes back in '08. But the
Yeah.
difference is that I learned from those mistakes. There was a
Mhm.
big problem, and I picked up the phone and I said, "Hey, can I join a mentorship program?" And at the time, I spent almost 30 grand back in '08 to learn multifamily because I didn't want to lose another 150 grand that I had already lost. So I learned
Yeah.
all these processes. And to me, it was like life changing because I started understanding the business. And
Hmm.
then when, 21, 22 came around, we didn't start jumping at deals. We said, how is this making any sense? Like, we can't make this sense of this.
Hmm.
And I'll give you an example how we got lucky. In the beginning, in that market cycle, we were able to buy some deals that had seller financing, which
Hmm.
really helped us because we didn't have to bring that
Yeah.
liquidity in, that equity in. We were
Yeah.
able to partner up with our business partner Mike, who had a strong balance sheet, but who saw the value in us.
Hmm.
Mike is, runs a hedge fund. He's a smart guy, but he doesn't have time to do multifamily, and
Yeah.
he loves real estate. So he partnered up with the two jabronis, Jake and Gino, because we were doing it full time. But we
Uh-huh.
needed him for his balance sheet and liquidity, but he needed us to execute this business plan. So it was a beautiful marriage. In
Yeah.
2017, that word syndication pops around, Brian. And we're like, you know what? We have to start syndicating deals because everybody's doing it and we have to learn it because we want to start teaching it in our community. We
Hmm.
syndicated 3 deals because there was a stopgap. Because what happened was I was still working at the restaurant in 2014. So whatever money I made from the real estate went back into the real estate. So
Hmm.
whenever we refinance the deal, it goes back into the real estate. The restaurant is paying for
Yeah.
my lifestyle. And I did that for 5 years.
It's a beautiful thing if you can do that too.
I was fortunate enough to do it. I was working a lot of hours, but I'm like, you know what?
Mhm.
I don't need to buy a Porsche. I don't need to, whatever money's coming in. We refied several millions of dollars each. So that
Mhm.
was able for us to continue to expand the portfolio. But in 2018, that's when we're like, we're out of money. Let's go out and start syndicating. And we did 3 syndications. They went for all full cycle, really great. But what Jake and I realized was if we can fund our own deals, we're not going to be able to buy 1,000 units a year. That's
Mhm.
okay. We can buy 200, 250 units a year. We're vertically integrated. As you had said before, we can't outgrow our infrastructure. That was the mindset with us. We just started slowing things down, being able to buy things internally within 3 hours of Knoxville so we can manage it ourselves. Obviously, there's less deal flow, there's less
Mhm.
vanity, but we're really building a business that's
Yeah.
scalable, that we can control, that we understand what our KPIs are. So for us, it was buy ourselves, syndicate, then go back to buy ourselves. And listen, Brian, the
Yeah.
toolbox is still there, it's still open. If a
Mhm.
deal comes where we can't buy with our own capital, we can always take that hammer out called syndication and
Yeah.
syndicate a deal. So I'm not saying it's off the table, but for the last 4 or 5 years, we haven't had
Yeah.
the need to. But when you say when the dam breaks and these deals start coming, they come all at once. We may not be able to fund them all at once.
Yeah. Yeah, and right now, I mean, looking at what's on the market, I think I've got 14 properties in my portfolio right now. Looking at where the market is, we're really close to that bottom. I thought we hit the bottom last year, but
Yes.
some markets, are still bottoming out. But when it comes down to it, what seller is going to put a property on the market knowing that we are at the bottom right now? And the answer is the guy that absolutely has to sell.
Uh-huh. Yep.
So I think we're still a year or two before buying starts getting easier, but there's just not a lot of properties on the market. So,
And the
um,
properties that are on the market, you just got to be very careful. They're
mhm.
older properties. They have a lot of
Yep.
capex. I mean, you can't buy 1970s at a 6 cap when interest rates are 7. You can't buy negative leverage in this part of the
Mhm.
market cycle. So you just have to be wary and you have to buy in actuals. And you have
Yeah.
to understand in your marketplace where is economic occupancy? Because
Mhm.
right now, nationwide occupancy is at like 92, 93% on average, where
Yeah.
2 or 3 years ago is 95, 96. So if you're underwriting for 95% for 2% rent growth, and really it's 90%, if you're lucky in some markets, because some markets are even
Yeah.
below that economically, you're going to be in for a world of hurt. That's what the buy right criteria comes in,
Mhm.
understanding where you are in the market and being conservative. And what you said rings true, limiting your downside risk. You're not going to get the deal, but that's okay
Yeah.
because no deal is better than a bad deal.
Yeah. Makes sense,
It
internally.
does. It
But the
does.
hard part is setting that criteria, being disciplined with that criteria. If you don't have that criteria, and this, I'm talking from experience on this one. I remember one of the first deals that we were doing, one of the first deals we had under contract. I was sitting with the broker at lunch and they said, "Hey, I've got this deal. The owners told us they want to sell it." A couple weeks later, I asked them, "Hey, is that still available?" And they're like, "Actually, right after I told you about it, they told me to pause." And so here I am, knowing that I'm the only person that knows that this is potentially
Ah.
all
Hmm.
right. And I'm thinking, no competition, awesome. I didn't have that criteria set. I was brand new. Just the idea of if I can meet that seller's price, I've got it. I've got something. I've got something. And without that criteria, I stretched it a little bit. Looking back
Hmm.
at it, I probably overpaid. It was 2019, so
Yeah.
but I overpaid at 2019 prices and
Hmm.
but I overpaid at those prices, but fortunately we had a market go up. But that's one of
Brian,
the yeah, anyway.
it's important that story because
Yeah.
I had told you before we hit record that Jake has never lost money on a real estate deal. And I
Mhm.
think he's the only investor that I know that has not lost money on a deal. It's because
Yeah.
I did. In 2007, the same thing. I bought a property and I vastly overpaid. I did so much capex on it and I held that property for 10 years. It was like a soul
Mhm.
sucking 10 years. Every time the phone would ring, I'd see Lou, property manager. We got a problem, Gino. What's the problem today, Lou? I mean, it was
Call me
just
with good news every once in a while, Lou. Come
never. It
on.
was I mean, like for 10 years, this thing
Yeah.
sucked at my soul. So that's why I was very diligent and
Mhm.
having a great partner. And that's the thing. When you're by yourself, you don't have somebody to bounce off. You have this cognitive dissonance and you have this
Yeah.
bias that you think you're smart and you think you're great. But when you pass it off to somebody, they start poking holes in it. It's like, oh, good. You need some objectivity in your life. And that's what
Yeah.
Jake and I give ourselves. So if you're afraid to go it alone, go out and find somebody that you can compliment. Go out and find somebody that you trust and that you value. And you say, well, that person would be great to be in business with, because that actually saved Jake a lot more than it saved myself because I was not willing to do a bad deal. Because 10 years thinking
Mhm.
about Lou, I don't want to have another 10 years of my life to deal with a problem like that. So we've passed on so many potential deals that now looking back, we should have bought them, but that's okay.
Yeah.
Because I'd rather pass on a deal and limit that pain than have to worry about, oh, I made 20 IRR. I'd rather take that off the table.
Yeah. Yeah, and you mentioned this before. I mean, you guys been very selective on deals, but you've still been able to pick up a couple of good properties.
Yes, yes.
Yeah.
And that's the thing when you think about it, you
Hmm.
could do more in
Hmm.
5 years than what you think of. People overestimate what they do in one, but they underestimate what they can do in five. Like in our first year, we got goose eggs, 18 months for our first deal. But
Hmm.
within 5 years, we were at like 700 units. Like
Hmm.
things start escalating because people
Yeah.
start seeing what you're doing. They start saying, well, you asked me to invest 3 years ago. I do want to invest with you, but now you got any deals? That's what ends up happening.
Yeah.
And don't be enamored by saying to yourself, I need to go big. I need to buy 100 units on my first deal. That's not how life works. I started
Hmm.
with a quad back in 2002, and I bought a couple of smaller deals. Jake and I, our first deal was only a 25 unit property, but it got us in the game. So that's the
Yeah.
goal. The goal is to get in the game and see if you like the game and see if the game is where you want to be for the next 5 or 6 years. And then once you do, okay, let me learn how to really build this thing. Let me learn how to become diligent on how, once again, buying, operating, and exiting. And then once you start doing that, it's okay. It's never going to be the right time to start.
Hmm.
I've got 6 children. I
Hmm.
don't ever remember saying to myself, now is the right time to have a kid. It
Oh
was
yeah.
never the right time to
Never.
have one kid, and it's never the right time to start something new. It's just once you've decided you've had enough pain being in the
Yeah.
restaurant, hiding in the kitchen, washing dishes. Once it comes to that point and you're like, this life sucks. That's
Pain
when I said to
motivates.
myself, I think
Yeah.
real estate's is the new path
Yeah.
for me.
I'm glad you mentioned the don't go after that 100 first off. I attended a conference recently where their group tells everybody, if you want to end up in the 100 plus units, you might as well start there. And I'm scratching my head thinking I've been doing this for 6 years now. My last acquisition was $6 million, 27 units,
Hmm.
and I haven't done a 100 plus unit deal in 4 years.
They're hard to come by now. That's
Yeah,
that's why. Yes.
and I'm scratching my head thinking, how is somebody brand new gonna, automatically be able to jump in, buy right, and know they're buying right, operate and exit with, yeah,
Hmm.
zero experience, zero credibility. Anyway, that's one of the things that really kind of irked me with how they were presenting stuff. But
Let me share a
yeah.
quick metaphor for everybody to understand what we're talking about. If Brian one day decides that he's hit his midlife crisis and he's like, I
Mhm.
want to run a marathon, is Brian going to get up and run 25 miles tomorrow? He's probably going to get up and maybe run a half a mile and see if he likes it. He's got
Yeah.
to buy the right shoes. He's got to be the right condition. He's got to feel good. He has to have it on his vision. It has to be
Yeah.
really, this is really what I want to do. But you start training slowly and you
Yeah.
start building up and you give yourself within the next 12 months, I'm going to do it. You're not going to just wake up one day and go, I'm running a marathon next week. Let me hit the tracks. I'm going to do 25 miles. That's not how life works.
No.
And it's the same thing with investing.
And if you do that, I know somebody who did that. Now, I am almost 50, so that midlife thing was perfect. Turn 50 later this year, but 10, 15 years ago, active duty military, we're all in pretty good shape. I know somebody that went out and just ran a marathon. His longest run prior to was 10 miles.
It's amazing.
And
But how many people do you know do that? Like, what's the probability
well,
of that happening?
he did it, but how did he feel the next week? He
Uh-huh.
was out of commission for like the next 2 weeks, stress
Uh-huh.
fractures, shin splints, so many other problems. And he regretted it. He's like, man, I wish I didn't do that. But I mean, I think it's a great example because I've seen somebody try to do it, succeed on the marathon, and then just the whole next month limp around because my hip still hurts, my knee still hurts, my ankle
Mhm.
still hurts. But
I would recommend a book
ah,
called Atomic Habits. James Clear wrote it. You probably read it, right? And I'm sure a
yeah.
lot of the listeners have listened to it.
It's on the shelf behind me. Yes, that's one book that I have on Audible, Kindle, and hard copy.
Yeah, I've actually listened to it as I go jogging now, and I've listened to it
Mhm.
4 times. And when you listen to it, it's not about the 100 unit goal. It's about the process that you need to build up, the
Yeah.
process of running that marathon. Once you fall in love with that process of talking to brokers, of talking to investors, of getting on podcasts, of underwriting deals, once you fall in love with that process, inevitably it will
Mhm.
take you to the 100 units, but you have to build the muscle to get there, or else you're going to quit after 2 weeks because you just burn
Yeah.
yourself out and it's unrealistic. So get that book, read the book,
Yeah.
digest it, read it again, and start mapping out how you're going to get to your 100 units.
Yeah. When it comes down to everything, right now, we're hyper focused on capital raising right now. And what we've realized is exactly what that book teaches. If you do the right things, eventually
Hmm.
you're going to get the results, and if you can
Hmm.
consistently make those right things a habit, eventually those results are going to come in. And so, yeah, you
Yep.
focus on doing the right thing first. So I got three questions, always ask at the end. First of those is what's next for you?
Great question.
Yeah.
And I've probably hit my post midlife crisis like you. I'm in my mid 50s right now.
Yeah.
And it's been great. It's been a good ride in multifamily. We're going to still continue to buy.
Hmm.
We're still looking for acquisitions. We're continuing to grow the portfolio. We're trying to become the Chick-fil-A of apartments, believe it or not. And,
Okay.
and that's Jake's motto. He wants to start delivering superior customer service, whether that's retentions, whether that's maintenance requests, whether that's getting fives on all of our scores when we're turning a unit, when we're delivering a unit. That's what
Hmm.
the focus is on the business. On the personal side, I've started a business with my family called Barbaro 360. We're really focusing on family, faith, and having families talk about money because
Hmm.
families with financial intelligence can change the world for the better. And once we empower families and parents to be able to talk to their kids about money and not avoid that conversation and prepare them for the real world. So when they become adults,
Yeah.
they can have some semblance of a good relationship with money. If we can help parents and families do that, that's what the mission is for us.
And that's huge. I mean, you're one of very few people that have more kids than I do. I've got five. I think you said six, you won that game. But yeah, that's a hard one, a hard subject to talk about and get kids to listen. I think that's the harder part is getting the kids to listen.
You got
But
to make it fun. You have to
yeah.
make it fun. I wrote a book called Baby Money Soldiers. I mean, if
Hmm.
you want to email, I can email it to anybody. It's Gino at jakeandgino.com. It's basically teaching kids finance through through games, through
Hmm.
visuals. Sit down and play Monopoly with the kid. Sit down
Hmm.
and play Cash Flow from Robert
Yeah.
Kiyosaki as a kid. Don't tell them, but involve them. I mean, Robert Kiyosaki's
Hmm.
game is great. He's got a
Yeah.
balance sheet and an income statement there. A 13-year-old's filling it out. It's fun. Then all of a sudden they
Yeah.
say, "Oh wow, what's an asset?" It's on there. So you have to make it fun, but you are mirroring that skill or that habit to the child.
Hmm.
So you just need to be careful if you're mirroring stress and
Yeah.
anger when it comes to money. Kids pick up on that unconsciously. So just be
Mhm.
aware of how you are towards them. And the worst thing is to avoid it altogether because you don't
Yeah.
want a child growing up in their 20s going, "I don't even know how to balance a checkbook." That's what you want to try to avoid at all costs.
That resonates. I mean, I think I've done better than my parents, but one thing that I definitely make sure I do is if I've got my kids in a car and I'm close to one of our properties,
Ah,
we swing by, you know.
yes, yes.
Yeah, we'll walk in, we'll talk to our leasing agent or the property manager or whoever's there. I'll grab the keys to the vacant units, and that's one thing that I try to do. And my son, I mean, this is several years ago. He was probably like 6 or 7 years old. He's 13 now. But I remember explaining it to him, and I said, "Well, we buy the property, and then the people that live here pay us money." And he just thought about it and his eyes got really big. He inhaled like, "Oh, Dad, we need to buy more of those." But yeah, that was like the best learned teaching moment I think I had ever. But anyway, people listening, barbaro360.com. I'll throw that link in the show notes. And then he also mentioned his free book. I'll throw a link to how to get that in the show notes as well. All right, Gino, next question for you. If you had to give advice to somebody who is just starting out, what would that advice be?
There's two ways to learn. You can either learn on the street or
Hmm.
you can learn in the classroom. Most of us learn on the street. We don't know any better. And
Hmm.
now the streets become AI, right? I think if you're really serious about this business and doing this long term, if people are willing to spend $200,000 on a 4-year degree, that is pretty worthless at the end of the day. Your ROI is horrible. Go out and find a mentor. If you want to learn how to coach your multifamily, Brian is here. He
Hmm.
coaches people. Find somebody who resonates with you. Find somebody who aligns with your values. Find someone who has had success because success leaves clues and go and I don't want to say just mentor, actually pay that individual. Because once you start investing in your education and once you start having some skin in the game, everything changes. Claude is great. Claude can teach you anything, but you're not accountable to Claude. Are you going to take Claude's advice? But if you've got a coaching call with Brian next week and he's paying you and you've got to look at 3 markets, underwrite 5 deals, and that Brian's expecting you to do it, you're not letting Brian down. You'll let
Yeah.
Claude down, but you're not letting Brian down. You're going
It's
to do
going to
the
be an
work.
uncomfortable call, you know? Yeah, it is. But yeah,
Yes. Make it as concise as possible. If you're
yeah,
serious about being in the business, go out and find a community and a group to invest in.
yeah. Love it, love it, love it. And just doubling down on that one, my biggest kind of hockey stick growth moments have all come after paid coaching, So
Mhm.
I wish I would have, cracked that nut a lot earlier. I think I was 41, 42 when I,
Same here, brother.
yeah,
Same
man.
here.
Wow.
At least you
So,
cracked it. Most people don't crack it. That's the
yeah,
thing. You cracked it.
cracked it. All right, last question. How can listeners learn more about you?
Just go to barbaro360.com. If any of this resonates with you,
Mhm.
if you want to work with your family, if you
Yeah.
want to subscribe to our podcast, we have the Jake and Gino show. And I've
Mhm.
actually got a show with my son. He's 23 years old. We call it the
Mhm.
Happy Money Podcast. It's
Nice.
really a conversation between a young adult and somebody who's made a lot of money and see what the differences are. If you want to be
Mhm.
part of that community, just go to barbaro360.com.
Awesome. And we'll put a link. I already said we'll put a link to that. But yeah, you can find the podcast there and everything. Now, I did pull up that link, and there's also a Julia and Gino show.
Yes, me and my wife have been doing a podcast for
Nice.
7 years. We actually
Really?
yeah, because we've really my wife's a life coach,
Yeah.
family coach, high performance coach. She's incredible. Homeschools the kids. So she got at one
Mhm.
point she saw me being a life coach. She goes, "What's this life coaching thing?" So she became a
Mhm.
life coach, and we've been able to interview guys like Dr. Gary Chapman 3 times, Dr.
Yeah.
John Gray who wrote Men Are From Mars, Women Are From
Mhm.
Venus. We've interviewed some incredible people on
Great.
the show. And it's like our weekly therapy. We get to sit there, we banter back and forth, and we're able to have these
Mhm.
conversations with these incredible thought leaders.
Awesome. Awesome. Well, for people listening, that's also available. I didn't know you'd been doing that for that long, but
Yeah,
wow, I just saw it on the Gino 360 or the Barbaro 360, and I'm like, that must be new. But
it's fun.
wow, awesome. Well, hey, Gino, very much appreciate your time today. A lot of, golden nuggets for people who are listening. And if you listen to this podcast, go back and listen to it again. I mean, there's a lot of things in there that you need to hear again, that I need to hear again too. But thanks a lot. Appreciate you. And I'll be following you now on Barbaro 360.
Yeah, thanks, Brian.